We've got Pankaj Sharma join us now. He's head of equities, Equirus Securities. Pankaj, good morning. Good to have you back on the show. Thanks very much. I just wanted your thoughts on the bankruptcy bill, which is now being cleared by both houses. Needs the president's signature, and then it can be enacted as law. Have you gone through at least some of the big features of the bill and what it can do? And also, more importantly, how long before it actually can be used in live situations, insolvency situations?
Yeah, I think that's very interesting because it was a kind of non-contentious situation for the government and also the opposition parties. So the passage of that bill was pretty smooth. Also, we expect that the presidential consent is only a bit of formality, so that should be done very soon. I think, of course, it will all depend on how the framework would be decided and how the government would think about that. That is still not very, very clear, but in principle, yes, I think the entire timeline which it requires to sort out these situations where things turn bad and the companies are not doing really great, I think that timeline can be compressed with the bill. So I think that is one very important point. Second thing is, if you look at in terms of the final clarity which would emerge with some more time, that how all these financial institutions and lenders would treat this situation, I think it gives them a very solid ground to actually track the people who are habitual defaulter and also sort that out. So I think these two things are very, very important, and I believe that once the presidential consents are done and then government has come out with a framework, I think it would be available in a practical situation very, very soon. It should not take more than 6 months or so.
In terms of acting as a trigger for lenders, the corporate exposed lenders, so are you saying, say in the next 2 or 3 quarters, we can start seeing the impact of this in a meaningful way?
That depends, because if you look at what happens on the situations which are already there, I think those situations will probably be more difficult to tackle. But going forward, I think the bill's objective also is more like devising a framework and giving more clarity on the future situations. But as far as the current scenarios are concerned, I think it's already very complicated, and the resolution of those situations would probably take more time. So I'm more hopeful about the situations which could arise in future and the problems which could be seen in next 5, 7, 10 years. But immediately the resolution of already existing problems and challenges, I think that's going to be a lot more difficult than what this bill can handle.
So, I mean, actually, to talk about this as a meaningful event for financials is not really all that great, right? I mean, you can't do that. You can't link this to that and say, well, this is a meaningful trigger.
Yes, not a trigger. I completely agree with you. It's not a trigger. I think it's more like a structural reform which the country needs and our financial sector needs. But if somebody thinks that it could be a trigger for the financials immediately, I would probably not agree on that point, because I think that it's going to be a lot more challenging to sort out the existing situations which are there and the banks are struggling with. But it's a very important structural reform, and that could be helpful in future. But immediately to believe that this would act as a trigger for financial sector, I think is a little too much to expect.
Got it. What's your overall sense about the market, Pankaj, and how we are poised?
Yeah, I think that's very interesting, Prashant, because I remember the conversation which we were having in last month and also before that. My sense is that we are in a phase where a bit more consolidation would continue for some more time. Of course, two things which have happened domestically is that one is that we are seeing that the earnings reported by corporates are not that bad. We have seen strong disappointments in first quarter this year, second quarter, and again in third quarter. But I think on that front, situation is better on fourth quarter. Also, what has happened that continuously there is a lot of positive momentum that has come on the hopes that monsoons would be good. So overall, at the domestic side, I think things are looking a little better than how they were 6 months back. But unfortunately, the reality is that the market performance is also very strongly linked to what happens internationally. And if you look at, I think those factors have been a bit more favorable in last couple of months. Example, the situation in China, what happens in the commodity prices, even on crude. So those factors have been really very, very helpful, and we have seen a meaningful interest from foreign investors in Indian markets. And that is more important. So despite us doing very well, I think if this trend sustains, I think it would be good for market. But for some reason, we believe that there is more uncertainty on global issues. I think that would not really help the local market. So domestically, definitely we are in a better shape versus how we were 6 months back. But market performance is very, very strongly linked to the international factors, and I think the situation continues to remain fragile on that. So there are a lot of situations which could probably be very, very important in next 3 months, like what happens on Britain, what happens in the China data. So all those things are very, very important for market direction. So I believe that it's a kind of situation where next 2-3 weeks we will be in a consolidation phase, maybe a range of 7,600 to 7,900.
Where are we, one space, if we go by earnings, where we've seen some demand recovery is, the consumer space, right? We've seen volumes picking up. Asian Paints, for example, reported decent numbers. You look at numbers from Cera, look at numbers from Century Ply, V-Guard, Kajaria, Imami, a whole swath of consumer names have reported decent volume growth. Could you use that, the fourth quarter growth, to say, well, things are definitely turning around, or could it be a flash in the pan? That's my first question. Why don't we begin there?
Sure. So I think not just all these names which are very, very specifically focused on a particular industry, even otherwise. So let's say, for example, what happens on the growth for Dabur, and also, as you rightly pointed out, Imami, all these volume growth numbers were okay. Of course, there was a bit of disappointment on HUL, but if we look at what people have been talking about in terms of the impact of, let's say, Patanjali, which could be more on Dabur or Imami, or even the sectors which are more exposed to real estate activity. So let's say Acera or the other firms which are in that business. So overall, I think that fourth quarter is definitely signaling a decent revival in demand, and I think that this trend would be more visible going forward. But considering what we have done before that, I think there was some impact of base effect also, so that would be helpful in fourth quarter numbers. But going forward, I think the situation is, as I said, is the demand side is not really as bad as it was maybe 6 months back. But whether this fourth quarter number can be taken as a trend, and that demand has completely recovered and strong volume growth revival is underway, probably I think we need a bit more time for that. Maybe a first quarter number which would come in July or August. I think we need those numbers to actually see a confirmation of a demand revival and volume growth revival.
And how would you rate what stocks have done based on these numbers? Because stocks have, in some cases, reacted disproportionately. Right?
Yeah, so I think that's very interesting, Prashant, because if you look at whenever you're coming out of a phase where you were struggling with volume growth, where you were struggling with the macro environment, and when something good happens, you definitely start building in a lot more optimism. So honestly speaking, the kind of reaction which even the frontline names like HUL did after the volume growth, that was in my view, it was a disappointment, but still the stock was largely okay. And as you rightly said, that even in cases where the volume growth had been better, the stock reaction could have been disproportionately different. So I believe that it's a little too much of optimism that is priced in, which I think demands caution. And I think we need some more data points to be very, very convinced about this volume growth and demand growth revival. And unless that happens, I think that the reaction of the stocks was definitely on the higher side than it should have been.
Any specific thoughts on something like Asian Paints? The stock trades at P multiples at par with consumer staple companies. It's a leader in the specific space I'm talking about. The numbers came out yesterday. Growth was strong. Just not just about the numbers, but where some of these stocks are trading.
Yeah, I think Asian Paints is a interesting story, because if you look at even last let's say 10 odd years, you would think that it's a stock where people really like the company, because it's a leader in the space, and also the branding is very, very strong. So I really don't see anything wrong in Asian Paints trading at the similar multiples where maybe a consumer company would be trading or consumer staple company would be trading. So I don't think fundamentally there is anything wrong in that. But in absolute terms, if you look at whether this multiple is justified, whether this multiple is fair, I think that is something which we can definitely question. So on a relative basis, I really don't have a problem in terms of Asian Paints trading at similar multiples versus consumer staples. That's perfectly fine, because the business really deserves that kind of a multiple. But in absolute terms, whether you are pricing it too fine, and whether the benefit of doubt is just too much in terms of what happens on next few quarters on growth terms, I think that is something which definitely can be a question mark and can be discussed, and can be we can definitely have arguments about that. But purely on a relative sense, I'm perfectly fine it trading at similar multiples versus consumer staples.
When people say that, the market will look very strong because earnings will take people by surprise, so be ready for re-rating and those kind of things. And then you look at individual stocks that one can actually buy. And you find, P multiples are already pricing in. I mean, in some cases they're at cycle highs, some cases they are decade and a half high P multiples, like in the case of Asian Paints. You find, it's already pricing in. So actually they are set up for disappointment if growth doesn't come. Can they do even better from here? That's debatable. Would you agree with that assessment, Pankaj, broadly? And I'm just talking about the consumer space across the board. Some of the home improvement companies that I said, staples, discretionaries, durables, just consumers.
I definitely think it's a very, very good point, Prashant, and I agree with that. And if you see what happens in a time which is not very great, so let's say if you look at the entire gamut of market and also the stocks which you have available in the sectors you have options with, in a situation like this, you are seeing that we are facing problems with our growth in IT industry. The sector is struggling. If you look at pharma, there are massive US FDA issues. If you look at metals, I think they have seen decent recovery in stock. But if you look at the fundamentals, I think they are still very, very weak. Infrastructure space is still a long way to go. So in an environment where you really don't have too much in terms of option available, you would probably pay a higher valuation for things which you think are relatively safe. And this is what is happening today with consumer stocks. So I completely agree with that once this cycle turns and once you start seeing that there are other sectors which are participating, there would be a definitely impact on these valuations. So if you look at even, let's say last time around 2007, 2006, the consumer stocks were not trading at very high multiples because there were other options available, because people were talking about industrial capex, people were talking about infrastructure story. So example, Larsen & Toubro, BHEL, even like I definitely remember that there was a time when ABB India was trading at almost 55-60x multiple. So it's all a relative preference kind of a game where you see that other sectors are not in that great a shape. You are paying a premium for this sector when you are seeing that there is bit more safety available, the growth has somewhat revived, and you are probably going to pay a lot more for that. But in absolute terms, can this sector underperform in next 18 to 24 months? I think that's a very real possibility. It is dependent on what happens on other sector. If there is a revival in other sectors, if other sectors start doing well, I think there is a very, very strong chance that average multiples in consumer space can actually come down. So it's a slightly long answer for your question, but I think broadly what you had asked me, I accept that, and I agree with that statement that there is a strong chance of disappointment if other sectors start doing well and better than what they are doing currently.
Now let's talk about the other sectors. Is there any chance that that will start to happen?
So I think some of the sectors where, let's say, I am not very, very negative on IT. I think that's something which is leading to a lot of disappointment, and there is a very interesting debate going on whether we have seen a structural decline in the growth rates we are going to see in IT sector. If you look at what the companies reported and what even guys like Cognizant have said, that's something which is very, very real. If you look at the growth, it's going to definitely be much lesser than how it was for, let's say, last 5 years or last 7-8 years. But as such, if you look at the sector, we are seeing the multiples which are not really very, very expensive. So in a sector where typically we don't have too much of an issue about the promoter quality or the corporate governance standards, I think the multiples where these stocks are trading at is a very, very interesting space, and I don't see too much of scope for disappointment and underperformance purely because valuations are very, very supportive. And I think that's something which will be important for this sector. As far as other sectors are concerned, I think you are seeing that there is a lot more interest in banking space. My view is that we are still at least 12 months away from seeing the final resolution on the issues banking sector is struggling with, bad assets and problems with their loan book, and it will take at least that much time. So I am not very sure about the excitement which is currently there in the banking space. As far as other sectors are concerned, I think pharma, for example, is I think real issue with US FDAs, and I think those things are going to continue for many of these companies, and the stocks would continue to have that impact. So it's a kind of mixed feeling. Consumers, I definitely think that it's not a very great situation as far as valuations are concerned. It's very, very expensive. There is a real chance of any derating if other sectors start doing well. IT is good. I think there is no issue in terms of the sector. If we are going to see even a 8 to 10% kind of growth for these names. Pharma, I think we still have a lot more issues. Banking, same. We think that it's going to take a bit more time before we see a final resolution of the issues which we have.
You know, one sector which is again starting to get talked about is real estate, right? That market generally believes that there are a number of positives which will boost the prospects for property developers. Some of these stocks have also started to show that, started to do well. Now, the underlying residential real estate market has been weak for about 4 years now. What's your sense? Is anything turning at the margin, or not even worth paying attention to?
No, I think it's definitely worth paying attention to. If you look at, let's say, commercial is doing well, and if you look at some of these developers in Bangalore and cities where commercial real estate is doing well, these developers have done pretty well. So commercial part is perfectly all right. It's doing reasonably okay. As far as residential is concerned, I think there is a lot of cleanup that is happening. So when you see developments like a huge penalty on a developer because the apartment delivery has been delayed, there is a chance that you would see a meaningful positive impact of the real estate bill. It would bring in more transparency. It would bring in much more cleaner structure where things are very, very transparent between a builder and a buyer. Similarly, on the other fundamental side, if you look at what has happened on the prices, I think in last 3 to 4 years, the prices have been so stagnant in residential market that finally we are seeing a lot more evidence that investors or speculators have kind of given up. There is more end user demand that we are seeing today in many tier 1 cities. Also, even if we assume that the salary growth levels are about 8 to 10%, and if you see that the overall affordability is increasing because the interest rates are coming down, there is a probability that 18 to 24 months time frame, we might see lot more changes which are going to work for residential guys, and that is something which I am very, very positive on. So I think if you look at this sector, I think this is one of the sectors where I would think that it's very, very ignored kind of a sector, but in last 6 months we have seen a lot of fundamental and structural changes. One, more transparency, very, very strong penalties on developers which are delaying the delivery and not really transparent in their dealing.
But if you look at it, but have interest rate drops been so significant so as to lure buyers back? The answer is no, right? Have prices corrected so much that take Bombay as an example, or maybe people say Bombay is on another planet, so we should not talk about Bombay. Look at other markets. Delhi, etc., has seen much sharper price increases, price cuts. Delhi NCR. But what is, is it just bullishness on behalf of equity investors? That is what we are seeing, right? But at the underlying, is anything changing? I mean, if you look at results, debt levels are rising quickly. 35% of newly launched properties in Bombay, for example, I'm again talking about Bombay, remains unsold. So, underlying on the ground, is anything changing? Or is it just a fad as far as stocks go, equity investors go? And it will pass.
No, I think Prashant, I think if you look at all the inventories that have been piling up, the debt levels at developers, I think it has not been accumulated over a couple of quarters. It has happened over the last 4 or 5 years. So if you say that the price cuts have not been significant, I would think that even if I assume that price cuts have not been significant, but with the same kind of prices which were there, let's say in 2011, 2012, now we are at the same levels. And not just Bombay, if you look at, let's say, even cities like Noida, even tier 1 cities which are not very much in focus, let's say if you talk about Bangalore, if you talk about Hyderabad, if you talk about Calcutta, if you talk about Ahmedabad, so these are the cities where the prices have virtually been stagnant. In a lot of cases, even they have declined. So I think overall affordability has definitely gone up. How much of that has translated into the buoyant sentiment of equity investors in stocks, that is something which is open to discussion. But fundamentally, in last 6 months, I definitely think that there has been more evidence that fundamentally things are getting better. And also, when you talk about the interest rate, even a let's say if you pass on only about 100 basis point, which could be half of the overall interest rate cuts which have happened in last couple of years, even that is a significant amount. It's a 25 years loan tenor. It's a property you're buying for almost 20-25 years, and that is something which is a significant impact on overall. So even if you believe that the EMI comes down by about, let's say, 55 rupees or 60 rupees per 1,000 rupees, it's a significant amount over 20 years or 25 years.
Pankaj, thanks very much for your time. Good speaking with you. Appreciate you joining in with that perspective this morning. Thank you indeed.